Hi, this is Nicholas Vardy, and welcome to the #1 investment strategy of all time and how you can profit from it. Let me ask you this. Have you ever shelled out thousands of dollars for an expensive financial newsletter that promised you pie-in-the-sky returns, but you never really reaped the big profits that you were promised? Have you ever handed over your money to a fast-talking broker who spent more time chasing hot stock tips and churning your account to generate big commissions for himself, rather than focusing you on the task of making you money? Have you ever secretly worried that you're going to lose it all in a coming financial crash and end up broke and dirt poor and unable to retire? If any of these apply to you, this could be the most important presentation you have ever watched. Let me tell you a little bit about my story. I spent over a dozen years as a mutual fund manager and later as a hedge fund manager. At one time, I was responsible for managing over $1 billion invested all across the globe. I ran the largest global investment fund in Canada, as well as one of the top-performing emerging markets funds in the United States. Now, in addition, I invested tens of thousands of dollars and hours in my trading and investment education. Now, I already had degrees from both Stanford and Harvard, but I never really stopped studying the markets because I really wanted to figure them out, and that was a commitment that I made to myself and all of my clients. So, as part of that process, I worked with some of the top trading and investment coaches in the world to hone my investment skills. I studied fundamental analysis, I studied technical analysis, I studied trading systems development with some of the top engineers from some of the top universities in Europe. But back in the real world, I was still frustrated by the sales-driven, product-pushing culture that I saw in the world of institutional retail investing. And what I saw was that the really big money was being made by the brokers and not by their clients. You know, I'd be giving presentations in places like Geneva, Switzerland, and then Monte Carlo, and all the way out to San Francisco and New York. But the story was always the same. The brokers were always pushing onto the clients whatever gave them the biggest commissions, whether that really made sense for the clients or not. You know, I kept thinking of the title of that old investment classic about the brokerage world in the 1920s. You know the one that's called Where Are All the Customers' Yachts? Then, in 2005, purely by accident, I came across the endowment model of investing. A friend of mine had invited me up to Cambridge University outside of London in the UK to interview for a position as bursar for a college at Cambridge. In the United Kingdom, that's like a chief financial officer, the one who's responsible for running the finances of the college and managing the endowment. Now, it was in preparation for that interview that I came across the work of David Swensen, head of the Yale Endowment, who had developed a long-term investment philosophy of investing that had catapulted Yale from enduring several severe years of financial woes in the 1970s to becoming one of the most profitable and cutting-edge investors in the world by the mid-1990s. It was a completely different way of looking at investing, and it changed the way I looked at investing overnight. I ended up not taking the job at Cambridge, but even then I began to wonder whether I could apply Swensen's insights to my own investing. But because Swensen's approach relied on investing in assets like commodities and private equity and hedge funds that were unavailable to small investors, it seemed like I was looking up a blind alley. You see, at the time there weren't the exchange-traded funds that are available now for small investors to invest in these asset classes. Now, that began to change in 2006 as more and more exchange-traded funds came to the market. And by 2008, it was a totally different world. The number of exchange-traded funds had exploded, and small investors could now invest in commodities, hedge funds, real estate, a whole range of assets that were unimaginable just a few years earlier. So I began to use the endowment model through the use of ETFs to manage my own family's money. And then I began to teach a few of my friends and colleagues about this approach. Well, it turns out they also began to have great success with it. And more of them kept asking me why I didn't offer this strategy to my clients at my investment firm, Global Guru Capital. Well, frankly, I was in kind of an embarrassing bind. After all, I was the global guru, and I was the editor of several successful trading and investment newsletters where I was helping thousands and thousands of clients identify highly profitable investment opportunities across the globe. And the success of the endowment model, even though it was making money consistently, was in many ways going against the very core of this kind of idea-picking approach I was representing in my newsletters. But after a lot of prodding from my friends and soul-searching on my own, I came to the conclusion that I should offer my most consistently profitable investment strategy to those many of my clients who had already entrusted me with big chunks of their retirement portfolios. So finally, after some serious reflection and some reluctance, I decided to launch the IV Plus investment program for my clients back in 2009. Now, why does this all matter to you? Well, if you're like most of my clients, your portfolio of U.S. stocks and bonds essentially made you no money over the past decade. In fact, when you account for the ravages of inflation, you're probably down about 30% in purchasing power. The story with the top university endowments, however, has been very different. Between 1983 and 2004, the Harvard endowment returned about 16% a year. And it wasn't just Harvard. Yale returned 17.4% and Stanford 15.1% in the decade through 2007. Now, as John Templeton, the famous global investor, said, if you do the same things as other people, you get the same results. So by that logic, the top university endowments, Harvard, Yale, and Stanford, were pursuing investment strategies that were vastly different from that of mainstream investors. And as my experience as a mutual fund manager and as a hedge fund manager had taught me, brokers and financial advisors had every reason not to advise you to pursue this particular endowment strategy. After all, it wasn't a commission-generating strategy. It was going to help for all the brokers and investment managers' yachts. So what is the secret behind the endowment investment model? Well, it's extreme diversification or asset allocation. That's really the key behind it. That is, the question is what you invest in, whether you invest in stocks or whether you invest in cash. It's that big picture decision that matters, not the individual stock or the individual money market fund that you actually invest in. Now, the benchmark for most financial planners and investors in the U.S. is to put 60% of your money in U.S. stocks and 40% in U.S. bonds. Now, that's pretty much what Harvard's portfolio looked like back in 1980. In 1980, 65% of Harvard's endowment was in U.S. stocks and 35% was in bonds. Now, today, Harvard's portfolio is much more diversified. It's only got 11% in U.S. stocks, and the rest is in fixed income, emerging markets, real estate, commodities, private equity, and even timber. And you really see that in this chart. You can see how Harvard's strategy has changed over the past 30 years. Over the course of the 1980s and the 1990s, Harvard transformed itself from a plain vanilla U.S. stock and bond endowment fund into a highly sophisticated, diversified investment portfolio. Now contrast this kind of 65% U.S. stock, 35% U.S. bond allocation with what you see in 2008, when by that time Harvard only had 11% of U.S. stocks and only about 9% in U.S. bonds. You see this even better in this following chart, which gives you a breakdown of what Harvard's portfolio looks like today. Today you see that Harvard's portfolio includes everything from foreign fixed income to high-yield bonds to foreign developed markets, emerging markets, real estate, commodities, timber, hedge funds, just a whole wide range of asset classes. And what's the most important point here? Well, it's when Harvard began to diversify away from U.S. stock and bonds that its returns really started to take off. It's only after implementing this investment approach that Harvard got really, really rich. And since then, many academic studies have confirmed that this highly diversified approach of the endowment model is by far the top-performing long-term investment strategy in the world. So the question remains, how can you invest like Harvard? Well, back in 2005, Yale's David Swensen recommended that the #1 best strategy for small investors was to assemble a diversified portfolio consisting of mainstream index funds with low fees. But actually a lot has changed since Swensen gave that advice in 2005. Back then, there weren't the vast array of new and rapidly growing number of exchange-traded funds that you have today that would allow you to mimic the endowment model. In fact, back in 2005, you couldn't invest more than 1/2 of your portfolio in the manner that Yale does. Today, you can invest all of your portfolio that way. And the number of ETFs that allow you to invest in each of these asset classes is growing by the month, making it easier to mimic the successful investment strategies of the top endowments. What's the bottom line here? Today, using exchange-traded funds, you can replicate the endowment model with little cost, little effort, and no hype. Now, what can you learn from Harvard? Now, if there's one thing that you can take away from this presentation, it's that the endowment model investing is the only genuine free lunch in the investing world. If you do pursue the endowment model, you will ensure your financial freedom, a secure retirement, and you'll save tens of thousands of dollars in fees and commission over your investment lifetime. If you don't pursue the endowment model, you're going to waste countless hours of chasing the latest investment fads and hot stock tips. You'll only have a fraction of the nest egg you need to retire, and it may end up even outliving your money. Let me tell you a little about the Ivy Plus investment program that I launched for my clients back in 2009. Now, the mission of the Ivy Plus investment program is to provide you with an opportunity to maximize your investment returns using the endowment model investing for your personal portfolio. How does it do this? The Ivy Plus investment program mimics the asset allocation strategy of the Harvard Endowment through the use of 15 and a growing number of exchange-traded funds. Now, the program was up about 29% in 2009. It was up about 10.5% in 2010. It's difficult to completely compare it to the Harvard Endowment, but let me give you this indication. Over the 12 months between July 1st, 2009 and June 30th, 2010, the performance of the Harvard Endowment matched the performance of the Ivy Plus program matched the Harvard Endowment almost exactly. So let me cover who the Ivy Plus program is not for. If you are a successful trader who can generate 20% annual returns consistently and without your eyes being glued to the screen day in, day out, then the Ivy Plus program is not for you. If you are happy to pay a big chunk of your profits in the stock market to Uncle Sam in the form of short-term capital gains taxes, then the Ivy Plus program is not for you. If you have the uncanny ability to predict the market better than most professionals and have the time and the psychological stamina to trade on the back of these predictions day in, day out, then the Ivy Plus program is not for you. But if you don't fit any of these categories and you have a minimum of $250,000 to invest, go ahead and call me on 1-800-910-6491 or contact me at nvardy@globalgurucapital.com to set up a free 20-minute consultation to see if the Ivy Plus investment program makes sense for you. And if I feel that the Ivy Plus investment program is not a good fit for you, I will tell you, because I only want clients whose philosophies match that of the Ivy Plus program. And if it's not a good fit, then you can pass this presentation on to someone for whom it might be a better fit. In the meantime, you can sign up for the Ivy Plus monthly performance report on www.globalgurucapital.com. You can visit my blog, nickvardy.com, for regular updates on the Ivy Plus investment program. But if you think the Ivy Plus program would be a good fit for you, pick up the phone and call me today, and I look forward to hearing from you. Thanks.